But to go back to the Fed, I would love to know
Yeah.
why we started this policy of quantitative easing, because we've had it in the UK as well, and it happened at the same time. It happened around 2010, 11 is when the Conservative government came to power for the first time, the ones that are still there. This is my entire adult life. And so they started the same policy, and in those first few years, they printed £435 billion, which is enough to give £6,000 to every single person in the UK. And
Yeah.
then they've increased it since then. So, like, what made us start this insane policy of just printing just obscene amounts of money?
Great question. So let's talk about it. But quickly, what I like about your book too is when you really start to get down to the mechanics of how these things work, it's always surprising. It's always more complicated than people think. And then there are always these dynamics of power. Who's making the decision to turn off the buy button and who's benefiting from all this? What the Fed has been doing is very similar in the sense that the Fed, okay, as we've talked about over the last decade, the Fed's been engaged in these really radical policies of driving growth through money printing, wild stuff. That graph you showed at the beginning, we could walk through like 10 graphs of that where history goes like this and then just explodes, you know? We're in a different territory. And the program at the heart of that is called quantitative easing, which the Fed really undertook in 2010. But when the Fed undertook it, it pressured other central banks to follow suit. That's one key reason why you see it in Europe, why you see it in the Central Bank of England,
Yeah,
the
the
euro.
ECB, yeah, the European Central Bank,
Exactly.
yeah.
Okay. So let's go back to the beginning of the book. The Lords of Easy Money or whatever starts on November 3rd, 2010.
Yes.
And a key thing here is the financial crisis of 2008, 2009 was a near, it was a cataclysm. It could have created a depression. I just want to emphasize the point that the Federal Reserve was largely responsible for that crisis because it had kept money so cheap for so long that it stoked these huge bubbles in the market for housing and stocks, what we call asset bubbles. When a central bank keeps lending too cheap for too long, it creates inflation. We all know that, right? Like the whole problem is if you keep money too cheap and too easy, it creates inflation. But there's two kinds of inflation. There's inflation for the things we buy and consume, like hot dogs, television sets, and cars. That's price inflation. But central banks can create asset inflation like they did with the housing bubble because they kept rates so low for so long that everybody starts borrowing to buy houses and the price rises to a level that's just simply unsustainable and then it crashes. So we see this tremendous crash in 08, 09. And it's cataclysmic. It wipes out trillions of dollars in wealth. The Fed responds by being the lender of last resort at a scale it's never done before. It prints $1 trillion to bail out the banks, to bail out foreign central banks like that in England or Brussels. And then we have this hangover, okay? That's '09. And the book opens in 2010 when economic growth is still really weak, the unemployment rate is still really high. And what's critical is the economists knew that life was going to be this way. When you have a financial crash, it takes a long time to dig out of that hole. But there was political pressure to do something about it. Unemployment is still at 10%. Growth is still really weak. There was so much political anger in America. And in 2010, we see this right-wing Tea Party movement take power in DC. Our democratic institutions in the United States become more and more paralyzed and dysfunctional. And so the central bank under the chairman, Ben Bernanke, says, you know what, we are going to push into the center here. Okay, we are going to become the engine of economic growth in America.
Mm-hmm.
And we're going to do it in the one way we can. We're going to print new money. Okay, and that's a really key thing to sit down and kind of think about. When you drive economic growth, you can do it through like Keynesian economics
Yeah.
of the government hiring people to dig ditches and build buildings and missiles or whatever.
Yeah.
This is a different thing. This is a central bank saying we're going to print hundreds of billions and eventually trillions of dollars and give it to the banks so that they do more risky lending and drive growth that way.
Why is that Ben Bernanke's decision? Like in what I am stunned here because obviously I'm aware that quantitative easing has happened, and I've been through your book, and I've seen that this is the case, that it was driven by the Fed, but like it's just dawned on me right there this second is like, why the fuck is that Ben Bernanke's decision? Like, he wasn't fucking elected. He's not Congress. And I'm fairly sure they're the only ones that are allowed to tax or at least allocate spending. Or I can't remember the exact language as far as I'm aware. So Congress are, as far as I'm aware, the only people who can, allocate the budget. So why is a central bank suddenly allowed to do that? I don't know why I've not thought of this before.
It's such like a profound, interesting, revealing question. So what you're talking about here is in the United States, you have so-called, quote, fiscal authorities, fiscal, tax, spend. This is our democratically controlled institutions like Congress and the White House. These are the people that can say, okay, folks, we are going to tax you. We're going to raise money and we're going to use that money to build a dam or a bridge or a school. And that's how society works.
Yeah, normally.
That's fiscal policy. But then you've got, quote, monetary policy, which is what the central bank does, which is manage a currency and then be the lender of last resort to the banks. So we're in this moment in 2010 where you've got this very ambitious chairman of the Fed named Ben Bernanke, who really is aggressive in terms of talking about ways central banks can increase their influence and be experimental. I mean, I chart it in the book all the way back in the year 2000. He was writing these papers about how central banks can do new and experimental things to stimulate growth. And quantitative easing, so-called QE, it's one of these experimental things that the bank had never done before. And what he's saying is, it's kind of amazing. He's like, forget interest rates. Forget raising and lowering interest rates, which is how the Fed used to primarily intervene in the economy. He's saying, here's what we're going to do. We're going to go out to Wall Street and we're going to go to this group of 24 select banks that are called primary dealers. And we're going to buy stuff from them. We're going to buy treasury bonds and mortgage debt. And we're going to make those purchases by just creating new money in the reserve accounts of these banks. So with quantitative easing, the Fed goes out to JP Morgan, says, hey, we want to buy $8 billion of treasury bonds from you. And JP Morgan says, okay, here you go. And then the Fed says, look in your special reserve account at the Fed. Boom, $8 billion just appeared. And the Fed does this over and over and over again until it has created, for example, the first round, $600 billion inside these bank accounts on Wall Street. And that's what quantitative easing is. Now, your primary question was like, who gave Bernanke the authority to do it?
Yeah.
Gray area, man, to be honest. Like, the Fed is given authority to do business with primary dealers. It's not explicitly barred from doing quantitative easing. The whole public debate around quantitative easing was essentially non-existent.
Yeah. Yeah.
And
I don't remember being asked. I mean, I was pretty young, but I don't remember anyone else being asked.
They just did it. And like, that's one of the key points of the book is these central banks have gathered up for themselves more and more power, authority, and reach, while the politics behind it has become more and more removed from general people. That's what bugs me about the phrase quantitative easing. It instantly just sounds like a science experiment or some PhD theory that we're not going to understand. Yeah. It's really just money printing to drive growth.
Yeah. Yeah. Well, yeah. Do you think people would feel differently if that's how it was described?
I know for a fact they would. And that's why Ben Bernanke, when this happened, he went on a huge American television show called 60 Minutes, watched by millions of people. And he said categorically on TV, we're not printing money. That's a misconception.
No, we're just
And what he
typing in
was
numbers in a computer. It's much easier. Like,
exactly. And people know intuitively that if you overuse the authority to create money, you're debasing the currency and creating dangers of inflation. And when he said we're not printing money, he was he was misleading the American people and obscuring what they were really doing. And you see this again and again. They cloak it in complexity. But when you really get down to it, they are doing these things that people react to, like, oh my God, you just created $1 trillion in the banking system to push banks to take on more risk and buy more assets and pump up the stock market. Like, that doesn't sound like a great way to drive economic growth. And
it seems like a very cheap and synthetic way to do it, or at least short-term cheap.
Short-term cheap is a great way to put it. And it builds up long-term risks. And it's like, if you could really achieve true sustainable prosperity through printing money, everybody would do it, right? If it was that easy, everybody would do it.
Thanks for making it all the way to the end of the video. Don't forget to like, share, subscribe, and leave a comment for us in the comments below. Let me know what you thought and if you'd like to see more of this from the show. Thank you, and we'll see you again next time.